market measure.
Sponsored by the CBOE.
Sponsored by the CBOE is 100% correct, son. Good job out of you.
4 option strategies in a quiet market. What would be your 4 guesses? Because I looked at the slide, so I don't want to.
4 options.
And these are trade ideas too. There's trade ideas baked into this, which is going to be
diagonals,
okay.
calendars, directional verticals.
Yes, debit spreads. You talking?
What's that?
You talking directional debit
spreads. That's right. That's right. And the 4th one. Are they going to go iron condors? Are they going to go that direction?
Well, you got 4 there.
Okay.
Calendar, diagonal, long spread.
Yeah.
Oh, yeah, you have both the spreads. Yeah.
I was going to go iron condor. That was going to be my 4th one, but I don't know.
Over the strangle. I think you might be right.
Oh, let's see.
Let's get to it. First slide, please. So while the market hovers near all-time high, implied volatility has dropped quickly below the average to 15. Mm-hmm. It's now at 14, I think is what I was looking at in the VIX. What's the VIX at right now? 1471. Ew.
Yep.
This creates challenges for options selling strategies as we continue to have over the last couple weeks here.
This is correct.
So when IV is lower, we'll jump to the next slide here. When IV is lower, risk increases due to having less credit received. You obviously have less premium here for anything you're selling. Shorter break-even distance, so you're getting closer to at the money. Those deltas are closer at the money relative to when you have high volatility. Those become further out of the money. So you have less cushion for the stock to move. Vulnerability to IV expansion. Obviously, volatility, when it gets low, it has a tendency to cluster and it kind of stays low. And then you have that pop in volatility. So you have potential volatility expansion risk there when volatility is this low or near the lows. Despite these challenges, there are 4 effective ways traders can utilize to navigate low IV markets effectively. So let's get into it. A couple trade ideas. So the first one here, debit spreads. You're right on the money. Yeah, you've done this before. Done this trading thing a couple times?
Once or twice. Once or twice.
1, 2, 3 times.
A couple of 2, 3 times.
So here's a quick little guide on when we would use these. So these are directional bias trades. We did one in Starbucks earlier this morning. Did you get filled on that? Yes.
I did. 247. That person is dead to me right now because it's trading at 244 or so.
Sorry.
Yep.
3 cents. Oof.
Yep. That's okay. That person who's my new best friend who scalped the SPX made up for your loss.
Make one, you lose one. It's okay.
That's correct.
50-50.
Net, you want to be positive. That's all you want to do.
So for the debit spreads, you got the call debit spread is a bullish trade, put debit spread bearish. The pros of these, you have less sensitivity to IV. You can even bucket put spreads or call spreads into this. I know those are short premium trades, but synthetically the same sort of thing. It's just where you make these trades. We typically trade credit spreads out of the money, debit spreads at the money, or as like kind of 50-50 shots. So obviously they benefit from a directional move. The credit spreads, higher pop, and they benefit from IV contraction because we're doing those out of the money. The cons of the debit spreads obviously are that they are 50-50 shots. Like these are slow moving, 50-50 shots. You got to get the move right. There's not much management. They're not, there's nothing sexy about them.
There's nothing sexy about them, and you can't do anything against them. You can, obviously, you can do whatever you want against something, but small amount of buying power used up front, 50-50 shot. It's like being long or short stock.
Yes.
Nothing else you can really say that.
Yes, totally.
Yep. Next slide, please.
So the example they're putting in is, research team is bearish on Google here. It's off Google currently. Where are we trading at right now?
Google.
239, down $1 and change. So they're looking at this yesterday or the other day, whenever this was on. It was at 234 and change. So you'd be doing a long put at 240 and then selling the 230 put. So it's a 50-50 shot. The way you'd set this up now, if you were doing, you could do like the 235, 240. So you're buying the 240, selling the 235, 50-50 shot. The 230 240 is kind of a little bit less than a 50-50 shot, but the stock has rallied here. But the point being is that you're doing this right at the money.
Yeah, you always
one strike
adjust.
out of the money, one strike in the money. Depending on how wide you want to go, if you want to go 2 and 2, 4 and 4, whatever, it doesn't matter. They're all going to be 50-50 shots, essentially, if you're looking at this sort of setup.
Classic tasty trade mechanics.
Yes, and just the key point here is that this is a strong directional play. It's defined risk. You don't really have much vol exposure to this position.
You have risk exposure.
You have risk. It's directional
risk. Thank you.
Next one, please. Time spreads. So we bucketed calendars and diagonals together. Makes perfect sense. So when to use these? If you have minimal directional bias, expect slow moving in that direction. So these are a little bit less directional up front, but they do have positive gamma to them in some fashion, especially in the diagonal spreads here, where you have different strikes and different expirations, calendar spreads being the same strikes, but different expirations. That's a true long vol trade as a calendar spread.
Yep.
A diagonal spread is a long vol trade, but it also has some delta exposure to it. So with the time spread, most of the time you have very low risk. The diagonal spread, you can add a little bit more risk because it's going to be a larger debit. The calendar spreads, low risk, low reward, low pop. They're just kind of nothing trades, very much engagement trades here. With the time spreads, they benefit from IV increasing or IV being realized. So if you have a big move in your direction, you're going to benefit from those positions. You have flexibility with your expiration combination. So you can do them shorter duration if you have more of a short-term directional bias. You can do them longer term like we did with November, October, SPY, the put diagonal, where it's kind of like just a general IV play with a little, you're playing for duration too.
You are playing for duration.
It's just kind of, if you were doing a 0-day trade for like a Adobe earnings, you would go into the weekly expiration. So there's a lot of flexibility here.
A lot of flexibility. I like the pros over the cons here.
Yes, and the management, I'm glad that they put this in the cons. Or I don't know if this is a con, and you could look at this as a pro as well, is the complex management. There's a lot of variables.
Yeah.
So like people ask, what do you do with your diagonal spread or calendar spread? If it goes your way, how do you make more on it? If it doesn't go your way, how do you manage it?
Define risk trade to begin with, so it's kind of a step above vertical spread that we just talked about with the management. Go ahead.
So you got flexibility there. I mean, if you're getting a move in your direction, you want to roll that short put a week out to collect more premium and kind of maintain that position. That totally justifiable.
Sure.
If you get a move against you and you want to buy back that short and just lean more directional into that move, that's you're buying in the short premium. That's going to add more directional risk to your original assumption. That's totally fine. You're getting more delta at a more advantageous price. So there's a lot of flexibility there with the time spreads.
I like it.
Which I think is a pro.
Yeah, I think it's a pro too. Any complex trade,
it's less easy. Like with short spreads or short premium, it's an easy, management in terms of like what the mechanics are. You just roll it out in time. You roll the untested side. Like those are easy things. You can apply that to any strangle or
doesn't take a lot of thinking.
Yes. These ones, you got to kind of make your bed with them. You got to, decide on if you want to be more short at higher prices or more long at lower prices. Next one, please. All right. So they're looking at a put calendar spread in SPY, which we actually did. We did a very similar one today. I mean, they're looking at the 650 calendar spread, November Oct. So you're long November, short October. We always do the long further out in time so that you're not naked in terms of your risk. If your short option is further out in time, you're synthetically naked. So this is pretty much exactly what I have on with the diagonal spread that I did with the 55-45. What did I do here? I did the 650 long in November. I did the October 635. So I did the diagonal spread with this same strike. So it's looking, and the reason they chose this strike for the calendar is because it's around the 40 delta. So you have a tiny bit of delta to the downside.
Very good.
I like it. Key point here, profit from time decay differential with limited risk. Got a little bit of positive theta decay, at least in the short term.
Keep going, son. You're like butter. You're on a roll.
Beautiful. So next one, poor man's covered call. So this is very much, you could bucket this in the diagonal spread situation, but this is a more directional trade. You have a higher delta, a little bit less exposure to volatility. So when to use is when you're bullish, low IV, limited capital, you're replacing stocks. So this is really about the capital, the advantage of being able to use less capital here. So the pros of this, and you're obviously selling the shorter dated call, it's a synthetic cover call. Pros, lower capital relative to buying shares. You have higher return on capital because you're using less capital, and it benefits from an increase in implied volatility. And that's because you're really synthetically long a put. That's your extrinsic value that you have in that long call option. So if you get a pop in volatility, that'll help you as well.
Absolutely. Absolutely. Good job. Good job.
And the difference, obviously, with cover calls, you get the dividends. And
you must have had an amazing teacher.
Tom, thank you so much for everything you taught me. No.
I can't
We
wait.
all know we all know, Tom, he's the wallet.
Yes.
You are the applicator of the teachings, of the trading.
Thank
you are the true talent of Tasty.
I was. Now you're going to be the true talent.
Yeah, thank you.
Yep. Next slide, please.
So we're looking at poor man's cover call in LULU. This stock is an absolute dog. 161. Did Tom trade this for earnings?
Mm-hmm.
Gone from 400 to 161 here. So they're looking at buying the January 155 call. I don't know if
He's traded before. He didn't trade it for earnings.
I don't know if you're going to be able to put a 126-day option in Tom's.
Yeah, no, I don't think he'll be able to do that.
I don't know if he'll be able to understand that one. Mm-hmm. But I like it. So you're buying the 155 call in January. Just to give you some context, it's about a 61 delta. You're going out to the October 170 call. You're selling that at about $4 and change, which gives you, around 25 long deltas. But that delta gets bigger as time passes because you're selling a 36 delta short option. So again, it's a directional play. It's synthetically a covered call type setup, much cheaper from a capital perspective than just buying shares.
100% agree. Good job. Keep it going.
Tesla up 23.
Yeah, Tesla's been on a tear.
Moving.
And you've got Microsoft up. It doesn't look like this. I mean, the market's not going anywhere. Well, we'll talk about the market in a minute.
Microsoft up 6.
Yep.
So last one, wide iron condors. This is important because, with a short premium, you're looking for high implied volatility. When volatility is low, those wings are cheap relative to volatility. And so it offsets that short premium, short volatility that you have. So we prefer selling premium when IV is high, obviously when it's low and you're looking for opportunities. Iron condors, wide iron condors, they give you that long vol exposure. They help give you a little bit of a buffer if volatility expands. The benefits of wide iron condors versus tight iron condors, obviously you're going to collect higher premium.
Sure.
Fact, you have a higher pop. You have smaller tail risk here because you're buying that wing to cap your risk.
Good job.
Next one, please.
Just the takeaways, I believe.
The takeaways,
Yeah.
yes, because they didn't want to give us the wide iron condor. They're afraid of Tom because Tom would say, no, can't do that. But you're buying IV.
Yeah,
IV
you're
with the
buying
wing.
IV, you're selling IV. It's a directional
You got to do
trade, I
something.
think.
We can't sit here and do nothing.
Yep. It's a directional trade just like any other.
Yeah,
I agree.
non-directional.
Yep, you just want to
Which
be
is directional.
inside the expected move.
Takeaways: when implied volatility is low, premium selling strategies like credit spread strangles and iron condors become challenging. Alternative strategies perform better in low IV. Debit spreads, time spreads, poor man's cover call offer a low risk and benefit from IV increasing and that realized implied volatility as well. All strategies still collect time value, so you keep traders engaged and profitable while waiting for richer premiums. Volatility will come back at some point. We don't know when it's going to come back, but it will at some point.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.